What I was looking at this morning was the ADP report first, and I noted that the leisure and hospitality was negative in the ADP report. And ADP is leading in some of the sectors, NFP reports. So I was surprised to see a 40K gain in leisure in this report. And it jumps out because there's a lot of like job growth out of that sector of the last years now, and it's very consistent. So it's still not slowing down. And I take comfort in saying like, well, this job market may be quote unquote loosening if you think of the job openings, or you think of even you can tell someone in continuing claims or other measures. But you think of leisure, that's like a growth engine for this job market, and that's I think positive. Against, look, it was good to see this influx of people back in labor force, as your other guest was talking about, and as your other guest was talking about. But what is important there to note is that the share of foreign immigrants as part of the labor force, that's increased now up to 20%. So I think what's going on the last few years is that as we get more people coming into the country, they get into the labor force and find work really quick. And I think that's a really important development, because if that continues, not only that keeps the job market like humming and going, it also is for productivity really important. And so the average hourly earnings, although they were up, but it was like 0.4% versus forecast 0.3, that's not like a dramatic increase such that that's really because of the effect from productivity. So it is in a way a Goldilocks number, a Goldilocks report, and why the markets are as they are. I mean, you would expect yields to jump by this much, and you would think that stocks would rally, and that's exactly what's going on. So again, a jobs report that says to me, this is an economy that does not warrant this excessive amount of rate cuts that we're seeing being priced in the market.
Hey, Ben, it's Nathan in D.C. Good to speak with you again. Does that mean that you're thinking that this job market is going to continue on this trajectory of the kind of growth that we have seen that's defied so much of what economists have been expecting for literally months now?
Yeah, it does look like that, Nathan, because the strikes, you see it being added into the headline, but the strikes itself did not have ripple effects in the economy that some people feared, right? Meaning you would get widespread job losses because of all the disruption, against somewhat of layoff trends that are ongoing, and the job openings declining. That is really just a marginal loosening of the labor market that allows other people to come back in and find work. So it's a competitive labor market. It's a market with momentum. The Kansas Fed puts out a labor momentum index, and I noted that index actually has barely changed over the last sort of 6 months, meaning it has not really declined in any way, even though you're seeing, like, for example, job openings declining or other indicators declining, which means loosening. That does indicate that people can find work and that there's momentum in this labor market.
And Ben, I'm looking at the WERP function right now. We've got about a coin flip odds for a first rate hike in March, and it looks like just over 4 expected in 2024. What's the market's read on kind of where the Fed sits, where we can take some of this data?
Yeah, if you take today's report, it does not argue that the Fed should go ahead and match market expectations. But we got to take note of what happened in June. They actually had penciled in 100 basis points of cuts at that time, and then revised it in September the 5th, right? And now the market's back to 100 or plus. So they could actually go back and say, hey, guess what? We'll just go along with the market. But I think a report like this probably tells them, like, we don't actually have to. It's really, highlighting how we think about the economy. It's moderating. It is a softer landing, even though that's not the official language. But it's an economy where they've done enough with restrictive policy rates so that it can get to a better, stable, state. And as a result, you don't have to necessarily forecast all those rate cuts. And I think that's next week, the tension in the markets. It will be, I think, somewhat taken back, where Powell will be, well, it sounds hawkish, but really was saying, like, see, we have enough data points to prove to you, markets, that these rate cuts are probably overextended. And as he said in his speech a week ago, he diffused the speculation there. You don't need to speculate on rate cuts. And so I think that will be a big message next week.
Yeah, I wanted to ask whether the narrative shifts when we get that inflation data next week. What do you think we're going to see from CPI?
Yeah, there will be pressure on CPI from the energy effect over the last month or so, Nathan, because that clearly will filter through now. And you can tell, right, from the nowcast of CPI or how the market is pricing CPI. I think that's fairly accurate. On the other hand, the sticky items that we've been following for many months probably stay stickier. That does not seems to be too much movement yet to happen there, even though the last CPI report was such a, I guess, groundbreaking data point of the owner's equivalent rent finally declining as the pandemic pressure gets out of that component. So that will be the big topic for next week too. Will that see a continuing decline? If so, probably the market will take it favorably. But for the Fed, it's all, again, playing in their hand and their message, like this is what they have been forecasting and what they've been expecting. So to them, it's more of a vindication of that their restrictive policy is working.
And looking at some of the granular data, I keep coming back to wage growth because it does seem like the Fed is very much fixated. Obviously, that's a big driver for inflation. When you look at the print from today, when you look at expectations into 2024 for wage growth, how does that play out and how does that factor into inflation and what the Fed can and will do?
Yeah, the wage trackers from the Atlanta Fed have all shown a moderation in most sectors, including the leisure sector. I think it's on a somewhat of a soft landing type path, just like how inflation has come down in a soft landing mode. And as basically the economy since 2021 has been declining down. So, and it's also effective productivity, right? We have a significant productivity pickup this year. So wage growth should start to moderate. As more people get in the labor force and you're getting somewhat of a let's say supply and demand rebalance, and therefore that wage pressure eases off. Again, that is favorable to the economy because it doesn't mean like it's outright wage deflation. First and foremost. Second, the real wages are likely going to be improving given that what inflation is doing. So I do think it's a positive development. Look, the average hourly earnings were a little bit up this today in this report, but not like alarming. The effect from the UAW negotiations, for example, isn't yet coming really through. So I'm not so sure if it's a wage price spiral idea. It's more of a moderation.
So is there room, Ben, for rate cuts of any size next year? I mean, I know there's still a debate about, whether we're going to see cuts as aggressive as the market's been pricing, but do you see cuts in any stretch next year?
So I find this a really important question, Nathan, because think about what we're going to go into next year. It's an election year, and the tension will be about the economy, obviously. And we know that if you keep rates too restrictive, that could affect the economy really negatively against, whatever fiscal stimulus that we're still pumping into the economy does start to fade off. And if you take it against that backdrop and the Fed continues to make ground against inflation, then it has put out this framework to manage this politically, saying, look, we have a high rate, we can bring it somewhat down as inflation is declining, because the difference between the nominal rate and inflation is getting wider, and therefore leaves some room to have the nominal rate go down, and that will be your rate cut. But it's literally taking out the most restrictive part from the Fed funds rate a little bit down. It's like insurance rate cut, as I say, that protects you against the downside for the economy. It's nothing about like an alarming rate cut. Okay, we got to ease policy really aggressively because we're about to slip in a major downturn.